Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, July 2nd, 2024. It's 10:04 a.m. Eastern Time. So I'm starting the video, so we're only about 30 minutes in the trading day. And what I want to do on this one, and we're going to go in this order. We're going to do an update on the equity markets. I'll touch on the market leading stocks, particularly NVIDIA. That's really all it's about right now. Talk on my trading plan, my positioning, which also will segue into Treasury bonds. I threw out that yesterday. I actually a couple posts told you we're in the in the 10-year, we're back into that orange zone, but also went long. The 30-year bond is both a either, well, again, you guys do what you want, either direct play, bounce trade, or a indirect hedge to equity shorts. Also going to cover on that same vein, if you will, as far as indirect hedges go. Also the metals and miners, I've thrown those out. I've covered those quite a bit recently. We were short into the lows, recently hit the final target, and then made a case to go long there. And I'm also viewing that as an indirect hedge, and I will explain why here in this video when we get to the Euro US dollar. So somebody asked today, I replied to the comment, maybe it came through yesterday. Do you see a marginal new high? It's still, about a coin toss odds I gave you last week. Both I have static charts. I linked that in the comment section. Posted this one last week, as well as I've covered it in videos. This is my target range zone, and I'll be honest with you, I'd really love to see QQQ get up here at about 511.74. I have a comparable level on SPY. Let me show you that real quick. And remember, this is again, this is a weekly chart. If we go to a daily, let me see if I have it here. Yeah, you can do it on a daily. We had those bearish engulfing candles on Thursday the 20th, and that pretty much marks the bottom of that range. So far, that's what's been capping this market out. And again, that's market top range, as the name implies. That's where I think that'll be it. The top for this entire rally off the October lows. And again, it's small. So whether I'm coin toss odds whether I'm going to keep a core short holding. I most likely will. NVIDIA by far is my biggest position as far as what consider it the stock market, if you will. NVIDIA and QQQ is an extreme overlap. If to be long or short NVIDIA or QQQ, it's the same trade because of like I said, both the mathematical and the psychological weighting. And I can tell you this, I'll get to NVIDIA in a second, that one I don't have any marginal new high. I think the odds are pretty good that the top is in on NVIDIA. I'll get to those in a second. So there it is. So we also have, if you want to play it safe, this is that weekly trend line. Again, it's been here. This is on a weekly chart. It gives you higher probability if you wait for a weekly candlestick close. The only downside I see to that is, it could happen pretty quick. And by the time the week is over, let's just say, hypothetically, it happens next week. It starts on Monday. We break this trend line. And then by the end of the week, you have 5 trading days to go next week. This will be an abbreviated week because of 4th of July. But so if it happened next week, you could be down by the end of the week 8%, theoretically, and like likely with the hot air I see right now. And so that's the downside. So when you want to, there's no easy solution. All I can tell you is that when you go to the shorter term charts, this is a daily chart. Here's the same trend line. You can wait for any break of the trend line can do the trick. But what happens sometimes when you take an intraday break, like right here, you see the candle close back on the trend line. So if you're trading on the daily time frame, it's going to get you in obviously quicker than the weekly chart. You can wait for a daily close, solid daily close below it. You can take the intraday break and just stop out if it whipsaws. That's probably your best bet if you take the intraday break and you see a solid close back above the trend line. Or you can zoom down to the 60-minute charts. These are the trend lines. We've had 3 trend line breaks recently. One right here. That was when I was on vacation in Italy. Gave you this trend line, saying that would be the first, sell signal on a short trade break of that trend line. This is your secondary trend line, and this is the third trend line break right there. So you have 1, 2, 3, and we're right a hair above that last one, right on where this one broke. And so this is what it looks like again on a 60-minute chart with the divergent highs and that's still the target. Whether we push on up to that marginal new high again, roughly 5.5% above there or not, I have a very high degree of confidence we're going to come down to this trend line, and also a lot more down the road, the 200-day moving averages, which still haven't been hit. But so there's your update. We've gone nowhere now for the last couple weeks. We're in this trading range here. Certainly the possibility, but like I said, cap to at max 5.5% upside above the recent highs. But we may not get there. We're still, remember, we've had 3 sell signals recently, and each of those are still very much intact. We're below all the 3 trend lines coming off that divergent high. And there's the, on the daily chart, these are your swing targets, longer term, what I call long-term swing or trend targets. And you can see them on the weekly chart as well right here. And again, that chart I got out to you last week, meaning a screenshot of it so you can duplicate it, or is in a couple of the videos I covered recently, and here it is again. And the S&P 500, similar chart here. You have the near-term uptrend line, you have a longer-term uptrend line, and you have a little more upside potential to the top. And again, those targets were based using both Fibonacci projections, price projections, and Fibonacci retracements. As I covered in the video, showing that if we had that push up there, the retracement levels come in perfectly with the price targets that I've already had in place before. And that's why, to me, unless I see something really compelling to convince me otherwise, I would be like a hard short all-in moment there with stop somewhat above. But we may not get there. Sometimes you have these, perfect little price targets, and there's just so much in the charts that I'm going to cover now that say, look, that may be it. Look, we're already cracking below the trend line here on SPY. Now, the week's not over yet. Again, Thursday's the 4th of July holiday, so you've got a couple more trading days left. And let me just rifle through the rest of the index charts and the market leading stocks. Let's do it that way. All right, so let me queue up QQQ. That then loads a watch list of all the components here. And so this is, I already gave you the 60-minute chart. This is a daily chart, shows you, these 2 trend lines. I had a little smaller minor trend line on the 60 below both of those. Bearish engulfing candle, multiple attempts to get above it, but I haven't been able to do so yet. And so you have several failures here. It's about 487 right there. And again, this next trend line, that's that one we're swinging down to on the 60-minute chart, your near-term target, where I expect a reaction upon the initial tag. Then once that goes, you can see these are different levels here. Again, just different support levels, i.e. price targets to the downside. But let me go over the big leaders now. Microsoft. I'm just going to stick to the daily chart. As I've said repeatedly and covered in many videos, you have divergences, big divergences that we haven't seen the likes of since at least leading up the 2021 top in the NASDAQ. That was November 2021. Was the beginning of 2022 for the S&P. That's the last time we've had such big incomparable divergences out on the weekly. But here's the daily chart, kind of get you a little more in there. So we keep making these divergent marginal new and divergent highs, and it's not as if each one hasn't produced a tradable correction. It has, but that's just one big consecutive divergent high, just like we had leading up to that November 2021 high. It finally played out for the big move, and so I see something similar. So there's your targets. My big level on Microsoft right here. The primary, or at least this uptrend line, purple's your major primary uptrend line. This is an intermediate term trend line off the 03 lows. And so you can see, and this was a near-term uptrend line that broke when the QQQ trend line broke recently, that put us on the first sell signal about 2 weeks ago, or a little less. And so we're below that. We're drifting a little higher. Sometimes you break down and have a little kickback rally and then go down. Sometimes you never look back. And sometimes you have a false breakdown. But there's nothing right now to say that that's what that is. Apple, it's kind of a meh chart. I had this marked up differently on a different board. Oh, it's a 60-minute chart. It's what I call right now an ADH, almost divergent high, meaning any equal high soon or marginal new high. Again, that would mesh with that, minor 5.5% upside in QQQ. Any new high soon, anytime soon, is guaranteed, 100% guaranteed to be a divergent high based on the how the indicators are lagging down here compared to price. So that's that. And so again, that keeps me open to that, very much open to that possibility. Be a slightly marginal and slight new high. Nvidia's played out like a, perfectly. There was our bearish. This is a 60-minute chart, but on the daily, that was our bearish engulfing candle. And again, this is of concentrated positions, my biggest one right now for the equity markets. But I'm going to get to the other things right now that I'm hedging up with, or pure playing, however you want to call it. I always say I don't take an indirect hedge. If you want to directly hedge up, you take a direct hedge. That means if you're long QQQ and you want to protect it, you can buy puts on QQQ. That's a direct hedge. But an indirect hedge, as you know, is I take something else that has a correlation, a typical correlation, and for the reasons I stated before. And I'll reiterate in this video how those hedges will work or should work. Minimum support target zone hit, bounced as expected. The bounce has been very muted. Again, this is Nvidia, the king of everything in my opinion, and others, meaning psychologically, probably the most important stock, hands down, I think, to the stock market right now. From a sentiment or psychological perspective. These are levels I've had. I can take this. Well, I'm going to add another line just to do it because I see a couple reaction highs here. If we zoom in tight, why did I have that line? Well, you have two reaction highs, 1, 2 recently, and you had a gap right here. And there was that, once that we tested that right there was support. So this is just another what I call micro level. But big picture, we hit. And my support first target zone, as you know, we bounced as expected. And I said, I don't think that bounce is going to go very far until at least we hit this trend line. We're get close, very, very close, but haven't had a full tag of it yet. And I still suspect we will. But then that's just kind of near term. I expect that trend line to go. The fact that we're so close to it now here in this other test, we may go down through it. Where initially I was expecting a more considerable reaction on the initial tag of this trend line. We came close enough here the other day to me, and this is how my brain works from experience, that's close enough to consider that an effective tag. Some people might have the trend line drawn. So in other words, guess what I'm trying to tell you is I don't have a desire to game a bounce off that level now. Had we hit it, maybe right here, yeah, that would have been a good opportunity to game a tradable long. I mean, look, you had an opportunity right there when you hit the first target zone. But either way, that's just the 60-minute chart. You go out to the daily chart. You can see here this trend line. It's pretty nice, pretty well defined. I'm going to tweak it. I'm going to pull it because that's what I do. You know what I'll do? I'll add a BOD. That's what I call benefit of the doubt trend line, which will mesh with the one I gave you on the 60-minute, or I was just showing you on the 60-minute chart. I haven't modified that one. But this one fits because you have a lot of reactions along the way, couple violations that I can see when I zoom in tightly. So I'm going to go like this, and that's going to duplicate the one I gave you and have given you and been updated on the 60-minute chart. Actually, when I draw it in, and what I'm doing is I'm catching the bottoms of 1, 2, 3, 4. Hopefully you can see it, 5 right there. So we've effectively, on the daily, the way you draw it here, we've hit it. So that's why that's been satisfied, and it's been a very muted bounce. Now we're still above it. So let me explain my thought process here. If you're bullish, and I know there's some, you can continue to say they're bullish and want see new highs, and they're going long every time I short. Someone says they're profitable. I don't know how that is on the trend line breaks because we're at or above. We're below the initial trend line breaks that we shorted the first two, as I showed you in the video. The third one we're right at or a hair above. But Nvidia, what you do, TA 101 or Trading 101 says when you are pulled back to support, there's a couple things to do. Number one, if you're bullish, you go long. Even if you're just a simple mechanical market agnostic trader, you have no opinion, you just trade the charts, you go long. You don't short it there. You wait for a break to go short, or you put a stop loss. If you go long, you put a stop below it. That's how you trade. So we're on trend line support. Bottom line is this was a short entry here the day you had a bearish engulfing, and with a stop somewhat above, and that remains. Again, I put a high degree of confidence we're not going to, even if the NASDAQ goes up and makes that, goes to the top of that bounce zone, I'm pretty sure Nvidia is done, is what it seems like to me based on the technicals and some other things. But again, we'll see. If it puts in a marginal high soon, it will still be a divergent high, so it's not the end of the world. 116.30 is good support. And then again, this is my daily chart. It's clean board. You don't have a lot of levels. I can go to my 60-minute chart, and that's where you have more what I call micro levels for an active swing trader. But this is, as I've covered many times, a big old thin zone that once 116.30 goes, I think it'll be a relatively swift ride down to 96.23. What does relatively mean? Relative, I think you know the definition of the word, but it doesn't mean one day. Could be, but it's very unlikely. But in just a short period of time, it took us, here, let's do it this way. It took us 1, 2, 3, 4 days to get up there. I could easily see us going down in 4 days or even less. So there's your relative. That could be, as quick as just a few days to get back down there. And then that comes in with this longer term, very, very good swing target. That's where, if and when we got there anytime soon, I'd most likely be gaming, reversing, going long for a tradable bounce off that level, and then waiting to reposition short on a bounce back into resistance and or a break below the longer term trend line. So that's NVIDIA big picture, and as I've covered many times, and most just don't grasp this concept. This stock, like most big semis, most semiconductors, has a history of high double-digit drops. We're talking 50% plus off these weekly divergent highs. This one's, I would say normally this is not any different, but it is actually different because sentiment is at such an extreme now. We've never seen it. This is the most overloved, overowned stock out there. And I talk all the time about technicals. That's the primary crux of the site is, using technical analysis to identify entries, exits, trading opportunities, buy points, sell points. But I very much factor in fundamental analysis. It's my initial background, business major, former stockbroker, financial advisor, very, well versed in fundamentals. And, if you're not aware, I turned CNBC on the other day on the computer. If you use the Thinkorswim platform, I don't know if you're aware, it's there. It's Interactive Brokers has Bloomberg TV live streaming. You can put it on your monitor, put a little box, so you don't have to have a whole big TV running. I just pop it on when there's economic reports, and if I want to see what the results are right away, or Fed meeting. And so what they talked about here, and this is what I know to be true, when they just reported. My God, they marched out. I've never seen them march out the Bull Brigade, the cheerleading squad, as much as the last earnings report on NVIDIA. They just, to the moon. So good. But what they brought up now, you don't usually see this there. I don't see it often. And they talked about not just NVIDIA, but the tech sector as a whole. The tech sector has been lifting this market, is earnings deceleration. And so, earnings were record. Earnings, just like you always get with Apple every quarter, they're always, almost with few exceptions, always better. They're growing. That's why these are big growth companies. But the rate of deceleration is crazy. So this was July of last year, quarter over quarter. The earnings were up 145%, the growth. Next, on October 23, they reported 40 cents a share. That's a 50% increase over the previous earnings, right? But you can see the deceleration. Look at that, growing at 145, 50. Growing at 30, growing at 17.5. You get the trend. So this stock is obviously, and like again, many big tech companies, you're seeing that earnings deceleration. So there's many scenarios out there. I can't talk on them all because it's unlimited number of scenarios. Number one, maybe this reverses and you see earnings acceleration, and then that would support the extreme valuations in both NVIDIA and the rest of the tech sector. You can also see, and we've seen not the extent we need to, a game of catch-up where everything else in the market, maybe just tech flattens out for a while, and then the rest of the NASDAQ 100 and the rest of the stock market starts to play a game of catch-up. Remember, I showed you quite a bit lately that QQQE, the equal-weighted NASDAQ 100, unlike the regular NASDAQ 100, has not. It peaked back here in 2021, and you have, like I said, similar sell signals to come on a break of this trend line here, big divergences and all that. So this just shows you that you can, it's one way to see the clear outperformance of the big tech. There's the 2021 peak in the regular NASDAQ. This is, again, it's not just me saying this. Others have just well documented. Almost exclusively just to a handful of stocks, those ones that, former FANG stocks, whatever you call them, former Mag 7 stocks. And again, it's you might say, well, what's wrong with that? We trade the Nasdaq. It's a good thing. Time and time again, history showed this is a signature trait of the end of a bull market, bull run. And you saw it here too. And you saw it in 2007 leading into the market top before the last real bear market that, was, ran its course until the Fed intervened. And that was a 55+% drop in the Nasdaq and S&P back then in 2007 to 2009 lows. So that's that. All right, let me go over the rest of them. I have Microsoft. I already covered it. Apple, like I said, I just covered that one. I'm sorry, almost divergent high. We were on NVIDIA. Alphabet, just a nice clean. See, this is why this could happen any day. This is a very well-defined uptrend line, aka bearish rising wedge. When you look at the divergence line right here, I mean the divergence has been building since back here. This is our main primary divergence line, and when we see it that big on the daily chart, then you want to go over to the weekly charts, and that's what you see here. So that's that same divergence line right here. It's been building, but you have even bigger divergence spanning all the way back here on the weekly. And then when you see that, then I go out to the monthly chart. You rarely ever get divergence on the monthly time frame, as I've covered in the past here. The only we did have some right here. I need to add that because I don't like it when I'm missing. I'm trying to show you that these things are not absolute. Now there was, if you see here, these are monthly candles. There was a correction, and it might not look like much, but from high to low after that divergent high, the stock fell almost 17%, and that's a period of over 6 months of correction right there. So, but the big divergence, that one was back here in 2007. Remember, Alphabet hasn't been around since before 2004. That was a 67% drop, and then this is the only divergence we've had since these two periods there on the weekly or monthly. I'm sorry, monthly time frame. All right, I've got a lot to cover, so let me just rifle through the rest. So that's it. Replicate that. I already have an alert, I'm sure, but I'll set an alert there. Your divergence lines, sell signal to come there. Amazon, same thing. Divergent high, divergent high, divergent high. Again, it's not as if they don't play out. Double-digit drop, double-digit drop. I believe those are both double digits. Yeah, 13% there on the first one, 9% on that second one, almost double-digit, and then boom, here we are. So just an extension of this big divergence. There's your uptrend line to watch. First one that comes into play, support levels, and additional sell signals will come if and when each are broken. Obviously, the odds for reaction upon the initial tag of each of these support levels or targets are likely. So an active trader. And again, I use this all in conjunction. If I'm trading NQ or QQQ, I'm going to look at the time that NQ is approaching support. Are these guys as well? If you have most of these market leaders approaching support at the same time, you're probably going to have the buy program step in. Buyers, humans and machines. If not, then you take out this level, you're going to go to the next, especially if the index and the majority of other market leaders, the big fangs, have also broken support. Then you go down to the next one. Meta, there's your nice clean uptrend line right here. You can see it comes off the late 2022 lows. So we're right on that now. So that's the thing. We're walking up the line. So we have key support levels. The last high was a divergent high. Any equal or marginal new high anytime soon is 100% guaranteed to be a divergent high. I'd say 100% due to how much the indicators are lagging. Now, anytime soon, that means if you went sideways for 6 months and then made a high, maybe these divergences get burned out, but anytime soon they will be a divergent high. And so that's why it all meshes with. And somebody asked me, hey, Randy, are you seeing the odds for marginal new high? Yeah, I could see, like I said, it's coin toss odds whether we're going to get that or not, but it's not going to change the technical posture anytime soon of these stocks. Broadcom, that's Broadcom. I have stuff on the 60-minute chart, but I didn't really intend to cover Broadcom. It's it's getting up there now. That's the other share class for Alphabet. Tesla, I highlighted this a couple months back. I said this was a big level, 198.16, bullish have taken out, and we did. We took it out, and look at the explosion off that level, but we're coming up. We're at one resistance level now, but this is the primary bear market downtrend. Remember, Tesla peaked all the way back in 2021 when the Nasdaq peaked, and has a bear market downtrend line that it keeps getting rejected off of. And I can almost assure you, if we hit it again soon with these overbought conditions, that's going to be a great exit for any long position and or a short entry. And so that's your update on the market leaders. Now let's kind of segue over to how to hedge up. TLT and ZB. You have TLT. This is the 30-year Treasury bond ETF. They say 20 to 20 plus, but they're targeting the 30-year bond. You have this uptrend line support and intersecting. I know this is a busy board, meaning I have a lot going on here, but the main things I'm going to draw for you: the primary downtrend line there, which we break out and back test, and this uptrend line here. So I didn't post this the other day. There's a lot that goes into my analysis, but that's I posted the long entry based on support on the 60 and 120 minute charts. And here's the 60-minute chart. That was it. So I got you out there right there. Nothing big so far. These are the first two targets for ZB or TLT, I'm sorry. And then I also had ZB for. This is a 15-minute chart. I didn't show you this one yesterday, but it had the nice positive divergence there. And so that's we were long at the lows, and still looks good up to at least this minimum. These are minimum, kind of quite likely coin toss odds whether I'm going to take profits there or there. But that's what I'm zeroing in on this 15-minute chart. If we can get a little more traction, one thing to do too, if you're bullish on bonds, somebody mentioned they were in one of the comment sections. If you took it yesterday, you set your stop and let it ride. And what you can do is ratchet up. If you get to this target, it's hit, maybe raise your stops to assure a profit and let it run. This could be a runner trade based on what I just showed you at the TLT at long-term support, those two intersecting trend lines, again, on the daily chart right here and here. So case could be made for a lot more. But as I mentioned, this is a if you take a oversized position, I said at least 2 times beta adjustment, that means twice what you take on QQQ, then the hedge works. So right now you're up a 0.5% in TLT times 2. That's over 1% gain. Versus if you are short QQQ, it's up 0.18, 1.8%, or 0.18. A fraction of percent. So you're more than 5 times offsetting the drawdown today on QQQ with that long if you took it yesterday on CB. The other one I took today, and should have probably started this out with you, shorted crude. Shorting crude also is an indirect hedge. Why am I shorting crude? Well, let me show you. All right, so I took that this morning. It's come down a little. So it was actually up this morning. So a little profitable, but I expect this is a minor, it's not minor, it's a decent, I expect this resistance level to fail. Big divergences here. Couple things to this. Number one, the economic indicators that I watch, the important ones, the ones that are more reliable, are rolling over and have been, the trend has been down. So that doesn't support. Now, yes, the other day I showed you crude's back in the orange zone, but remember that's also resistance. I'll get to USO in a second. So based on these divergences, very overbought conditions, I'm viewing this as an indirect hedge too, because if crude goes down, that would support this crude moving up, as I mentioned, and that's the whole point of the orange zone. Normally and historically, especially, let me say this again, especially over the last couple of years when inflation's been everything about this market, rising crude prices have put the brakes on the stock market. Remember, over the last couple of years, I've showed you that negative feedback loop. And what it says is, and this is what I expect. You're going to have periods of abatement in inflationary forces, meaning commodity prices, particularly crude, that's the most important, goes down, which then brings, inflation goes down, interest rates go down, bonds drop, which means stocks rally. But then stocks go up. So that's implying good future economic growth and the inflation trade return. So these are the cycles. And so you can't have both. Crude is now punching through, getting here. Let me go to USO for you. So here's we're smack into my orange zone. We had this trend line right here, which broke, and we're just back testing it. So that was the other reason. You had a uptrend line, breakdown, high level back test. I don't think we're going to make it straight up to the top of the orange. If we do, I'll double up on the crude short because that's resistance, big resistance. But remember, I gave you this post yesterday. Last time I pointed out crude and TLT in the orange zone, IEF, the 10-year bond, was back here in early April, and that was the biggest drop we had in a year in the stock market all year. And and that was proved to be correct then. So again, you enter these orange zones, USO, which we're in. Now, my point is, so why did I short it? We're in it, and that's bullish. No, well, first of all, we're getting overbought. There's a technical case that I just made to short it, and it's also an indirect hedge because if crude keeps going up, especially pushing to high into the orange zone or into the red zone. Again, you can see that was early April right there. What happened to the stock market? QQQ, early April was right here. This was early April. And again, as I showed you, that was the biggest drop all year by far without even a close second. And it's not random coincidence. What happened back then is what's going to happen again. This will start to be talked about on Bubble TV. They'll come out and they'll say, oh, well, where do you think inflation's going to go next month? If crude oil has gone up just since here, right here, since the end of May, almost the beginning of June, crude oil prices have surged by 17%. Where do you think the CPI, that's a good, and remember, crude trickles into the CPI faster than food commodity prices because, commodity prices, corn, wheat, soybean futures, the spot price, those aren't in the CPI. It's the finished product, the breads, grains, and where, they're getting a lot of pushback from consumers. So it takes time for those prices to trickle up. This is an immediate impact. When crude goes up 16%, you bet your bottom dollar the gas station's the price on the pump's going up. And it goes up pretty quickly. So therefore, the market is not pricing this in. So I feel pretty good on this. It's again an indirect hedge because if crude continues to go up, I'm going to lose on my crude short, but the stock market's going to take it on the chin and very soon from this. In fact, it's already not reflecting this as it is. And if I'm lucky, that's why I do these indirect hedges. More often than not, they do play out. Guess what? I make money on this, and if stocks fall and treasuries go up, I can make money on all three. That sometimes happens, but that's how I'm trading it. So it's both a pure play. You can see here on the 60-minute chart for USO, that's a divergent high. I don't have all my annotations marked up here, but that's a DH right there, as was this last high here. That was a divergent low. It's divergent low there. And so that's that. So there it is. So crude, like I said, either a pure play short or indirect hedge to an index short. So all these, and that's why I said I may just sit tight on the swing positions from those recent sell signals on QQQ, most certainly on NVIDIA, and ride out if we happen to push up to those the max, that 5.5% more upside. Again, I'll let you know. It doesn't matter what I do. Really shouldn't affect what you're doing. I'm giving you analysis. I'm sharing levels to watch. But I can tell you this: if that breaks, that's going to be a pretty powerful sell signal on crude on USO right there, and we're probably not going to make it to the top. I mean, we could break and then back test. That's the thing, guys. There's always a myriad of possibility. I'm showing you levels in what I consider the most probable and likely scenarios. So that's one there. Maybe not. But I can tell you a breakdown's a sell signal just like the last three were on this 60-minute chart. 1, 2, 3, and they haven't played out for much. You're profitable from the first one. You're about break even on the second, and you're slightly underwater if you only took the third right there. Okay, and if Treasury bonds and crude oil aren't enough for a hedge, well, you've got your gold and silver too, which also tend to go up and down with the stock market. Why? But this can also be an indirect hedge. Some viewing it as such. So going back a few weeks ago, I pointed out here, we've been swinging gold and silver and the metals and miners based on this chart here. This is EUR USD. You've got the divergent high there. I highlighted at the time. We had a sell signal on the break right there. And that drop, there's a very high correlation. I've covered it many times. This video is getting a little long. I'm not going to do it here. If you're brand new to the site, just ask me in the comment section. I'll put up a chart and show you. It's not hard to do. I'll just do it here for you. There's a super strong correlation between gold and the euro US dollar pair, which is basically between gold and the dollar, and I just use the euro USD pair. is my proxy, and you can see they go up and down together. So if you know where US dollar is going, you can blindfold yourself and trade gold. It's very easy. There are times of what I call unusual and temporary disconnects between the two when there's overwhelming supply or demand for gold. But other than that, it's a simple mathematical based formula, is that gold is priced as we're trading it. I'm trading it. If you're trading gold futures or GLD, the ETF in the US, then it's priced in US dollars. If you live in Switzerland or Argentina, you're going to want to trade gold based on your currency. But as far as that goes, it's simple. When the dollar goes down in value, it takes more dollars to buy an ounce of gold. That's why gold goes up if you freeze supply and demand. Likewise, when the dollar is appreciating in value, it's a strong dollar. It takes fewer dollars to buy an ounce of gold. So we'll use this. The euro is just the euro-US dollar pairs. The euro against the dollar is just upside down. And again, it shows that correlation. So right there, you had a divergent high, correction in the euro, divergent low, as I pointed out. And as I recently pointed out, the divergence has gotten even bigger. And so made the case here to go long. And in fact, that's when we covered a gold short. Remember, we had gold as a short trade. Here, we are coming off that divergent high. We hit my first, second, third, fourth, and final target right there, reverse. And it's been moving up. It's not going very far. Why isn't it going far? Well, because what I just showed you. The euro's kind of going sideways until these guys are going together. Now, bottom line is you still have this divergent low in place. And guess what? Gold is not the only thing highly correlated with the euro. You also have, you got it, as I cover quite often, the stock market. So this is why I'm very much open to the potential for that marginal new high, because if the euro does rally off this divergent low, then that's going to help close this gap. As I pointed out recently, we've seen a very unusual divergence between the stock market holding up. It's still off its highs from a couple weeks ago, particularly QQQ and SPY, but the euro's been going down. The stock that usually would have brought the stock market down. And so if this rallies, the euro, it has a potential to support this recent outperformance or unusual disconnect, if you will, or inverse correlation between the stock market and euro. So by being long things that are sensitive to the euro-US dollar, such as gold or silver, then that's why I'm viewing that as an indirect hedge. Because if the euro does rally, that doesn't guarantee the stock market's going to continue to go up, but it helps, it's a net tailwind, if you will, for the stock market, right? It should be net bullish. Net bullish doesn't guarantee the stock market go up. It just, again, this correlation is nearly immutable. I've covered it many times. You can go back the last couple of years and see that the euro and US dollar and stock market correlation. So again, I'm viewing gold, silver, the precious metals as a hedge, indirect hedge. They're longs based on their own merits, their own technicals. So far, it's been moving up. And then silver as well. Silver, you have the, which is usually my go-to. I tend to overweight silver, especially when the case can be made on the technicals. Coming off, we had a divergent low, you had a rally, second, just extended the divergence. We are back testing that trend line from above, so we need to pop that to open the door for the next target. And of course, you want to see gold and the euro going up to help support that. So there it is, guys. And guess what? So if the euro turns around and craps out, gold and silver are going to most likely crap out or go down with them, but the stock market will also as well. Like I said, we've had an unusual divergence between equities and the euro-US dollar, and those things don't matter till they do, is what I like to say. And I promise you they will. I've done this, again, I've covered it many, many times, showed you the divergences, and then there's always a mean reversion. And that mean reversion, I'm talking between the stock market and the euro right now, can manifest in one of several ways, but you're going to see either euro coming up, stocks going down, or a little of both. That's the mean reversion. So there it is, guys. It's kind of simple stuff. So again, since we have a very resilient market, we're still above that longer term, more significant uptrend line in QQQ. And we're just spitting distance from highs, and also that potential max bounce target I gave you. To me, it makes sense to be hedged up Like I said, for me, indirect hedges. I've told you before, I'm not a big fan of direct hedges. They cost money. If I don't have enough confidence to be, short QQQ, that I have to buy calls on it to hedge, I'll just sell it. I'll just close the position out. It costs money to buy, and when you have a direct offsetting hedges, so yeah, you're gonna, when you're short, you can buy calls on QQQ. If QQQ goes up, your calls profit, but you also have all the premiums in there that you're paying, time and volatility premiums and other things like that, and the costs. So why do it? You're just, you're the only person making money on that trade is your broker. It's an offsetting trade, so that's my thing. I like indirect hedges instead of direct hedges. And like I say, if you get the technicals right and the logic behind them, which I just spent 20 minutes explaining, quite often it can profit from all of them or two of the three. That's and let's look at that. Silver's up today 0.74%, again against a QQQ short that's only up 0.14. And so, like I said, in TLT, still up, what was it, 0.5% earlier, 0.4%. So firing on all cylinders today. All right, last but not least, that's a lot of stuff I just threw out for you. I covered just about a week or so ago my top, one of my favorite of the ag commodities. Wheat's kind of been stalling out, sucking wind, but I told you soybeans would look the best to me, and that's also a position. It's not anything to do. It's not a hedge, indirect or otherwise. It's uncorrelated to the stock market. But I gave you, this is a 60-minute chart, showed you was putting in a divergent low here around support. I expected that took out those previous lows, which was a divergent low. That gave us a rally last time from that level up to the top. That was about a 10% rally off that divergent low there. And if I'm not mistaken, I told you in the video we had just undercut it, and I expected it to be regained. If you did regain it, you had two reasons to go long: a break of the downtrend line, which we've since taken out, and a recovery back above 2382. So no, it's not running on fire. It's soybeans. It's not Bitcoin or Nvidia. It's not going to go up as much or down. It's an agricultural commodity. But again, the charts are constructive based on this 60-minute chart as well as a daily chart. And you go to the daily chart, you got that big divergent low. Actually, it should already be marked. Nope. Duplicate. No, that's a big divergent low here on the daily chart. This is long-term support right here. It's a support zone. And these are still, remember, we already hit it. We were long off this divergent low, and we hit T1, which we got a reaction as expected. It was a little deeper than I expected to go, but with that being said, it gave us a much bigger divergent low. So that one's still very much and it tends to run, it's one of the grains. Remember, this is wheat. Wheat put in a divergent low here. We went on to hit my first and second swing targets. And these are still the next targets, and we're still above that divergent low, and wheat's starting to pick up here, and it most likely will. If soybeans plays out, then that will as well. So there's a divergent low on the PPO. This is WEAT. Let me show you the futures real quick, because that's what I trade. This is ZS wheat futures. This is, I also believe covered that in the video last week for you. There's your beautiful little downtrend line, bullish falling wedge, positive divergence, just my kind of chart. Swing it up, swing it down, divergent high, trend line break, correction, divergent low, bullish falling wedge, breakout right here. First target effectively hit. And once we take that out, 1126 and a quarter, we should go up to the next target there. Once that one's taken out, there, and then there, and that's it. And now at this point, if maybe a back test, if we get it, that would offer an objective entry. However, if we fail and go back below the trend line, I'm talking about the primary downtrend line right here, that would be a failed breakout. At the very least, I think a stop below the recent lows makes sense. Sometimes in the last few months, a lot of these, you get these rallies, and they've been more swing instead of trend tradable trades. I'm talking on the grains, but ultimately longer term, and you can look at things like DBA, which is a ETN or ETF that has the ag commodities in there. You've got them all. Oops, I didn't mean to move that line, but I was trying to show you this. This has got cattle, soybeans, sugar, corn, cocoa, wheat, coffee, hogs, cotton, everything in there. And you can see this one is also at, let me grab my drawing tool, at support right here. This was these recent lows. It's holding that. You've got additional support just below it around 23. And by every metric that I can use in technical analysis, nobody can argue this. This is not debatable. It's in a uptrend, a bull trend. This was a bear market. Started back in 2008, right when after the stock market peaked. We had a bear market in commodities that ended when COVID hit and the government flooded the market. Both the Fed and the federal government flooded us with fiscal and monetary stimulus. And to me, that's simply the initial leg up, followed by the first corrective wave in a new bull market, with the second wave up and another corrective wave. And I'll be looking, as I've been talking about and doing, buying pullbacks to support. That's it. By the way, that first corrective wave there, as I've covered this many times in the past, was a 38.2% retracement. So that helps support the case. That was just a typical run-of-the-mill retracement or corrective wave in a new bull market that most likely has more upside to go. So therefore, that's why I'm not going to give up on, wheat and corn and soybeans coming in, on these pullbacks to support. This is a weekly chart on corn, CORN. Big divergent low there on the daily as well. And again, just corrective wave, in my opinion, that's most likely closer to over than if not already over. And if not, guess what? It's a uncorrelated, completely uncorrelated asset class to the stock market or to bonds or anything else. And it's another way to be diversified and spread your bets. Don't put all your eggs in one basket. All right, guys, that's it. Just to recap, my views on the market, coin toss odds, whether we put in a top a couple weeks ago and we keep testing that top, or we've got about another 5.5% to go if it wants to make a marginal new high. Meanwhile, Treasury bonds and gold and silver look like good either pure play hedges pure play trades or indirect hedges to equity short, as does a crude short. So again, long bonds, long metals, but short crude oil. Those are my three indirect hedges, and also and/or direct plays, if you want to call it that. And then soybeans, my favorite of the grains right now, but they're all probably going to run together most likely. And there used to be a grain ETF that no longer exists, JJG, that had all three. So if you want to spread your bets, you sprinkle a little cash in each one, overweighting. That's what I'm doing, overweighting soybeans. All right, I'm going to wrap it here. This has been Randy Finney with Right Side of the Chart. Have a great